watching Dukascopy TV. I'm Elaine Stenson and I'm joined in the studio now by independent market strategist Bruno Estier. He's here with me now to look at the technical aspects of the markets, and today we're going to be looking at copper. Bruno, you're very welcome.
Good morning, Elaine.
So the last time you mentioned that copper is a leading indicator of global economic recovery. Now the equity market has tumbled a little. Can we trust copper?
Yes, indeed. Copper is called Dr. Copper. You know, it's a joke in the world of technical analysis, just because it is a leading indicator of growth. If you use copper in materials, in housing, in different things, and therefore when the demand for copper comes, price of copper rises, and therefore usually you have an economic recovery, global or not. Currently, I'd like to focus on what happened in 2002 to 2014, the last 12 years.
Yeah.
First of all, we notice on that chart, on the top part, we have something similar to copper, which is basically the index of base metals. So it's not only copper, but all the other metals that you use in the industrial world. And we see there are similar lines, right? We have a big move up from 2003 to 2006, about 2007, then a kind of a consolidation or a first stop in 2006, a second one in 2008, and of course with the crisis, the financial crisis, there was the beginning of a slowdown in growth, and therefore also copper went down as well as the other base metals.
Okay.
And right now, we are now in 2012, and for now 12 months,
yeah.
Okay, we see declining highs, but we see also at the 300 levels, or 298, a kind of a floor. And the question is, this just little tiny candle here that we're going to watch better on a daily chart, which it has been moving up, right? Does it announce a global recovery? Well, it is a really recent event. As you can see, the low was in August, and now we have moved from 306 to 340.
Yeah.
This 340, I put it a black line because it used to be a ceiling also in May and June, and it used to be a support in the past, meaning a floor. And that's why we call that a pivot. As long as prices are below the pivot line, 340, that means there is a risk that price do not go through it and pull back around 315. That's our likely scenario.
Okay. And if copper is stalling as you're expecting, what will this mean for bonds?
Well, that's exactly an excellent question, because if growth slows down, what does it mean for bonds? Usually when growth slows down, in the recent past, we had interest rate moving down a little bit. So here we are basically adopting a very contrarian view, right? You are noticing here that interest rates are moving from 160 to 280. And why do we speak about interest rate pulling back, right? Well, there are two elements. The first one is that we are now close to what we called the ceilings, right? These two blue lines are ceiling line, if you wish. One drawn on the closing prices of, here we have a monthly chart, and the second one take the extreme. So if you wish, it is not an exact line, but it is an area where price may stall. And that's probably what may happen, because we're going to see it on the next chart. The break might not be a good and genuine break. It might be a bull trap. What is a bull trap? It means that everybody thinks it's going higher and it reverses below the key levels. What are these key levels? We have been to 292, and the key level is probably 270. And if prices are able in the coming days to move back down 270, then probably that means that all the rise that we had for a little while, namely in the last 3 months, is going to be replaced by a neutral trading range, or probably even a pullback toward 250.
If US interest rates stop rising for a few weeks, what will this mean for equity in the US and in Europe?
Well, first of all, in general, if interest rates move down, as we said, that means slower growth.
Yes.
That means that what we have been discussing in the past interviews, where we had looked at Europe and Europe outperforming somehow the US because it was lagging the movement of the US,
Yes.
we see that Europe probably might not have enough steam to go through its own ceiling. And probably it means that we are going to move sideways, which is a little bit contradictory, right? Usually in financial analysis, when interest rates are lower, it is good for stocks. But here it is more a matter of, is it growth globally, which is signaled by rising interest rate, or is it a slowdown of growth, which is signaled by slowing down interest rate on their weight, on their ascent, or on their speed of ascent. And therefore, we keep with the same view concerning the S&P, where we had two paths, if you wish, a blue path or a red path. And what we noticed from last week, where we mentioned we could rebound from the area of 1640, 1620, we had rebounded already, but the rebound is modest.
Okay.
And because it is modest, it opens some worries about the rest of the correction, and that seems to corroborate the fact that interest rates are starting to slow down their rate of ascent, and therefore it confirms somehow the correction that we were speaking all around for a few times.
Bruno, thank you for that as always.
You're welcome.
And that's all we have time for now, but do check back later for further updates and interviews from the Dukascopy TV team. Bye for now.